Well, good morning, traders and investors. My name is Roger Scott, and I'm the senior strategist for WealthPress. Now, usually, 99% of the time, I do this video nice and early in the morning. But today, I had I have an obligation. I'm traveling Friday and Saturday all day. So I decided to do this video Thursday after the closing bell. I figured there's enough follow through to give me enough analysis. So what you're looking at right now in this video is actually based on Thursday's closing bell, but I did wait till about 15 minutes after the close. Now, as you could see here, the markets are not holding up as well as anyone would examine or appear them to be. And if you look at the S&P 500, we are starting to lose some ground. I've been telling anybody, and I mean anybody who would be listening to me, that we're backing off the 200-day moving average. Now, I know we closed near the highs, but the fact is we're still making lower lows, and that's the bottom line. And if you look at the QQQ, you will see that as well. One other thing that we saw this week quite prominently is markets that were opening higher or going higher and then coming back down. That's becoming more and more prevalent. And one of the reasons that's becoming prevalent is because Fed's been doing a lot of talking. So, for example, today we had comments from, now remember, this is Thursday, but this is going to impact the market tomorrow morning no matter what you think. Comments from Fed, St. Louis Fed President Bullard pushed the 10-year note up 8 basis points to 3.768 when he said interest rates might need to raise from 5 to 7%. Look at me. Ouch. To attain sufficient restrictive levels. Even mention of the 7% federal fund rate spooks markets and is not going to cause a rally. Bullard said, thus far, the change in the monetary policy stance appears to have had only limited effects on observed inflation. And to attain sufficiently restrictive levels, the policy rate will need to be increased further between 5 and 7%. Folks, what I'm hearing here is that 0.50% basis hike rate right now at about 80% versus 15 or 20% of 75. I see that moving back the other way around. Now, we've had some better than expected numbers from Cisco, NVIDIA, Macy's, and unemployment data isn't really impacting the market negatively. It's still between the 200 and 250 level. The housing numbers are not good, and the Philadelphia Fed Outlook survey fell as well. So put the call ratios kind of neutral right now, and if you look at the bond market, which is becoming more and more important than ever, you will notice it's not holding. So we had a nice little rally. We had a nice little vacation from recession, from inflation. Everybody thought the market's going bullish again. The bond market rallied. And it only took 1, 2, 3, 4, 5 days for it to stall out, and it couldn't even go to the resistance level. This is not a strong market, folks. This is a weak market. And as I expected and predicted a few days ago, the Dow Jones is actually down. Huffs and puffs and then starts making lower low. This is the lowest low we saw this week. And my expectation is that the Dow's going to hit the 200-day moving average sooner than later. Now, looking at individual sectors, and this is where things get a little interesting. So utilities is starting to cool off. Energy, financial is starting to heat up again. It looks like a nice little pullback there on the financial and the energy sector. But again, I'm not letting this market fool me, and I think we're overbought. Overall, if you look at the real estate, it couldn't even close near the highs. If you look at consumer discretionary and technology, they don't look like they have a lot of holding power. And matter of fact, if we look at XLY, which we will look at right now, you will see that there's a lot of selling pressure here. And it looks like this sector is going to start hitting the low. I wouldn't be surprised if by the end of next week, we hit the 132.50 level and tested this low right here. Very, very, very. I mean, look at this downtrend. So as far as consumer stocks, I'm not really happy with them. And as far as the stocks that would be on my chopping block right now, let me just kind of tell you where I'm at. Honestly, folks, selling consumer discretionary right now is probably the lowest hanging fruit. So let me give you some on that. Amazon, Seagate, Global Payments, I've already talked about payment processors slowing down. Live Nation Entertainment, people are going to concerts a lot less. That was one of the stocks on my chopping block. Avalon Bay Communities, housing communities right now, REITs, AVB. This is a big, big REIT. They built up big communities in California. I think they're going to see a slowdown. Take-Two Interactive, even though long-term, I love, love, love this stock. They're on the chopping block right now. Disney is not looking good at all. Expedia is not looking good at all. Those are the type of stocks I would be selling right now. Those stocks are just not looking great. Also, Intel is starting to lose market cap. Let me show you overall how INTC is looking. So right now, instead of looking at stocks to rally, I would be looking for stocks that are fading the rally that we had over the last few weeks. The rally started right around middle of October, and it seems to have ended right around middle of November, and it looks like it's behind us now. So what I'm expecting is the number of stocks making 20-day lows to start increasing. I think this number is going to start increasing. Right now, there's only 61 stocks making 20-day highs, 26 stocks making 20-day lows. The market is very neutral right now. It's not really moving in any directional bias, which is choppiness. But I think this number is going to start decreasing. So what I'm looking for next week is higher yield on bonds, meaning bonds lower. Let me show you what I'm looking at. I'm looking at lower bonds, higher interest rates. I'm looking at this number to start cooling off and start testing the lows around the 93.57 on the TLT. I'm looking for the Dow Jones to finally start giving up some of the gains that we saw over the last couple of weeks, over the last month, and start getting back to the 200-day moving average, and more consumer stocks starting to go into the red. Now, folks, right now, one of the coolest things is I have a sector rotation strategy, and this sector rotation strategy actually has a hedge, because what it does is let me show you real quickly. So we're looking at 11 sectors right now, right? Look at this. So these are all 11 sectors. Now look at this. In the last 6 months, energy has gained 17%. Communication services lost 18%. Why would you want to have the communication services in your portfolio? That's 50 stocks out of the S&P, give or take, that have gone down an average of 18%. You don't need that. Or how about consumer discretionary? You don't need that. Or better yet, why not short this to the downside or buy a put and have a protection? So while your energy and your industrial stocks and your financial stocks are making money, you have a nice hedge. Wouldn't that be great? Well, that's what we're talking about today. And I'm telling you right now, this is the way to trade. Now, folks, I'm going to tell you something. As we discussed in the morning video, we're in a long-term downtrend, and right now overbought in short-term and volatile overall. And I think this is a perfect opportunity to go downside or hedge your portfolio. If you don't have short exposure, listen to me right now. You need to have a hedge in this type of market environment. It's critical. We've seen it over and over again this year. One bad earnings surprise, an unexpected move by the Fed, or a surprise CPI reading, and the market can switch directions instantly like that. That's where a hedge can help and give you peace of mind. Now, I've put together a trading course to break down my favorite hedge trading strategy that you could start using today. Now, this strategy allows you to have your cake and eat it too. Follow the link below, learn about alpha rotation. It gives you exposure long in the strongest sectors and exposure to the short side via put in the weakest sectors. What could be better than that? When we had the COVID crash, this thing killed it, destroyed it, obliterated it. It didn't just protect, it made money. I think 60% one rotation, 80% another rotation, because the hedge that we had, which was energy at the time, really killed it. So get into alpha rotation. Check out this class. It'll teach you and explain to you why avoiding the middle ground, avoiding all this meat in between and just focusing on the strongest and focusing on the weakest could be your ticket to Wall Street in 2023. Start early, start in November and December. This market is gearing up for volatility, and this is a great asset to have in volatility. Check out Alpha Rotation, do it now, and I'll see you later. Make sure, like this video, subscribe to this channel, send me emails, support@marketgeeks.com. Bye, guys. Have a great weekend. Bye.